Going over winning percentages in algorithmic trading. This is the portfolio calculator updated through June 24th. Today's Saturday, June the 25th. And I want to look at the winning percentages of the last 10 days on average. So I put this formula in my calculator. And it looks at column, the daily P&L, E2. So the last 10 days, count if it is greater than 0 and divide by 10. That gives you a quick winning percentage. Where are we historically going back to 2008 as a winning percentage? It feels like our winning percentage would be smaller than it has been historically, but it's not. And so one of the things you could garner from this is potentially start trading when it's 30 or 40%. And stop trading when it's 60 or 70%. We're always looking for better ways to time the market, time the strategies, and I have more ideas than I can ever test. And so this is one of my latest ideas, is look at the winning percentage of the last 10 days, or you could change the last 20 days, or 21 days, or 23 days. There's between 21 and 23 trading days per month. And so you could use that number instead of the last 10. You could potentially time it based on winning percentage. That's not something I've done yet. And you have to rework this calculator to multiply by 0, multiply the daily P&L by 0 if it's less than that threshold, or if it's greater than that threshold, time the threshold. So something I may work on in the future, but I wanted to share that with you, as well as the latest portfolio calculator results and some potential updates. This is the portfolio calculator updated through Friday, June 24th, and this is Saturday. I changed it to 25th for some calculations and changes that I would consider making. And so 26 strategies, released this on June 13th, and we traded it on June 13th, and then we stopped. And so we were at a worst case drawdown, and we had a nice 3-month run, 50% run up in our 200K portfolio. Made about $100,000 on the 200K portfolio, and then gave back about $30,000, around $30,000. The very beginning of June, and we stopped. And so risk management. Now this thing sold off sharply and then bounced back sharply yesterday. Let's look at the daily P&Ls, and you can see here is June. Lots of losing trades, lots of big losing trades. We stopped after June 13th. We took that trade and then we stopped and continued into its drawdown. Made a worst case drawdown on June 23rd. And then on June 24th, had one of its biggest winning days of plus 28K. And so from June 14th through June 24th, it is up 9,000. So it's up 9,000 since we stopped, but we would have had to take another $20,000 drawdown to stay in that, and we didn't. So it's up 9,000, but it went through this massive drawdown, and it had this massive winning day yesterday. So I'm disappointed that we didn't catch that. One of my gut feelings was that it might be a good time to get in, but I have not done researching with my data and some of the things I want to do with the data analysis. It is in the lower 30% range, so 30 or 40% might be a good time to start, winning percentage wise. If you do that though, if you look at, you're at an equity peak here at 50%, and you start when you're in 40%, you would have started on the 6th. So you could combine that. It would have been in a $24,000 drawdown, and you would have endured up to a $40,000 drawdown. If you wait for a 30% down, you'd have waited until the 13th, and so you would have started trading maybe on the 14th, and so you might have started trading when we stopped. If you started trading after there's only been 30% of the days that are winners. This is not 30% of the trades, it's 30% of the days, the winning days. And so you could have started here, you would have gone into a $20,000 drawdown, and then you had this big pop. There's different ways you could do this. And so I'm excited about the possibilities. Finding ways to time portfolios is not easy, and there's not been a lot of successful ways to jump in and out of portfolios, but this is one way that I'm excited about, that I will spend more time diving into and considering, as well as the trading systems that we're looking at. So one of the things that I've noticed in this portfolio is that adaptive moving average made a huge difference. And so If we remove adaptive moving average, we reduce that drawdown. It's been one of our biggest winners. So it's a double-edged sword. Adaptive moving average, very aggressive strategy. So if we remove adaptive moving average, that worst case drawdown goes from 65 to 41. It was very, very active. It lost, had some big losing days here recently, and it after a big run up though. So it was one of our top strategies. And then you would be up this month. Just without adaptive moving average, you'd be up this month. You would be just at this drawdown level, not a huge worst case drawdown. Would have bounced back. What are some other things we could have done? I've spent many hours looking at new strategies and iterations of strategies and iterations of this portfolio calculator, looking for redundancies though. So when we're wrong, we're not as wrong. You know, the idea that, hey, this tick pullback, it works great. Let's jump in on this. Let's trade two different variations of it. It can capture bear market rallies, sharp bear market rallies. We've gotten stopped out a lot on this strategy. It did well for us, and then the bear market rallies have really faded quickly lately. Before yesterday, prior to yesterday, in the entire month of June. And so, what if we reduce the redundancy on tick pullback and we improve it once again? 39K is the worst case drawdown, so we don't have as much redundancy there. It's up on the month. Let's see where it would have been on the drawdown. Again, not a huge worst case drawdown, just a small worst case drawdown. And then it bounced, and then we had we'll look at maybe gap continuation. Gap continuation, let's see, where is that? Gap continuation, we have two versions of this. And so if it doesn't work, you know, when it's working, you like to have two, but when it's not working, you don't like having two variations of the same strategy. So let's remove gap continuation 2022. Worst case drawdown is 35K. It's only in a $9,000 drawdown. So if you transition to this, it's in a run up, and you kind of have to wait for it to go into a drawdown again. And so it still made a worst case drawdown. Let's look at some of these others. There's some other things we could do. We have a new version of adaptive moving average that takes money management into account. And so if you add that back, you know, you boost your current drawdown, you boost your max drawdown. So I'm not sure if we're going to add the new version of adaptive moving average right now. And so let's look at, those are some initial things we could have done. Those just remove adaptive moving average, you could remove both tick pullbacks. Let's remove the other tick pullback as well. Let's remove this tick pullback and see how it would have done. And so you're at 29,000 and a $3,600 drawdown now. So now you have to wait for another drawdown. This number goes up to 55.62. Let's look at the drawdown curve. So much better, much better. And so just removing the tick pullbacks and the adaptive moving average, which trades just got carried away. Let's see. What if we add the gap continuation 2022 back? And just remove both tick pullbacks and adaptive moving average. 31,595, 55.32. Are we at a worst case drawdown? Nope, we're not. So you could keep that gap continuation. What does it look like with adaptive moving average and both tick pullbacks removed? The new adaptive moving average. Also, we have the new tick pulse. That I'm gonna set that up as well. So you get the new tick pulse, and so this is you're at 45.60 when you do that. And let's look at the new tick pulse on the NASDAQ. So tick pulse, where is that? We have the new tick pulse. And we fixed the long side on that. And you're 42 and 19. Let's look at, so you're at worst case drawdown. Let's remove the adaptive moving average again. So even with the money management, it's still pretty active. It's had a pretty sharp drawdown. You're at 32, you're at 54.65. And so let's look at the drawdown curve. Once again, It's a lot of work developing trading systems, algorithmic portfolio trading systems, and so you're down here, it's bounced, and so this looks like a pretty good setup right here. We also have some new strategies that are listed and others that are not. Trend overlap is one that I really liked. And so if we add that, what do we get? 55.91. It's at a new equity peak with this setup. Making those changes that included an overactive adaptive moving average and tick pullbacks. Let's look at the drawdown curve. So yeah, I mean we've removed some biases. Those tick pullbacks are long only. Let's remove the gap continuation again. $54.34 that drops, so it's better with, in this setup it's better with it. That strategy has not done terrible. 55.91, and so that's just the NASDAQ strategy. You still have 24 strategies. You've basically removed, we still have 10 S&P or 9 S&P strategies. Removed adaptive moving average, and on the NASDAQ we removed we changed the tick pulse to tick pulse from tick pulse V12 to tick pulse 2022. We removed 2 tick pullback strategies and added the trend overlap. And I have some other strategies I'm going to release that I'm working on. And so you could also add parabolic VSD. VSD, I'm hesitant to add too many new strategies. I'm hesitant to make too many changes. Obviously, the biggest factor in this whole portfolio was an overactive adaptive moving average. And so this is what we're looking at. If we do trade this, we do need to wait for a drawdown because it's at an equity peak. And so that's the caveat when you go through these types of drawdowns, and then one day has a massive run up, and then you transition. You know, you're in a drawdown. In real trading, you don't want to transition to jump right back in at equity peaks. And so this thing has regular drawdowns at this level, 10 and 15K drawdowns, and so that is something to consider to scale in on a drawdown. And we could be in for a bullish phase, and the bull side has been easier to trade because it's been trendier, while the choppy market conditions have just been a massive chop. And so that's what I wanted to share with you today, the portfolio calculator update, some potential changes that I'm looking at, additional new strategies as well that I haven't even revealed yet. Hey, David Bean here. Welcome to Capstone Trading Systems YouTube page. Be sure to subscribe to join our community of algorithmic traders. We are real money traders. We share our winning streaks, we share our losing streaks, as well as market updates, strategies, and coding tips.